So in chapter 10, we're going to continue our examination of budgeting and how we can use that to plan and control our operations. And you may remember when we were talking last week, or in the video I put out last week, that when we looked at the spending variances for our costs, I indicated that where that spending variance would indicate that we were off budget because we spent, let's say, a different amount for direct materials than we had budgeted, I alluded to the fact that there might be multiple factors contributing to that variance. And that's what we want to address this week. So, for example, if we are off budget in our direct material costs, that may be because we paid a different price for our direct materials than we had intended to, or because we used a different quantity of direct materials in the product that we were manufacturing than we had planned. And it's important to understand how much each of those two factors are contributing to the variance, because if we want to address that variance, we may do it differently depending on whether we're paying a different price or we're using a different quantity. So what I want to do to illustrate this is use the very same example we looked at last week with the clothing manufacturer, but we're going to carry the spending variance analysis one step further. Before we do that, I want to introduce another term. This term is introduced in your reading for this week in chapter 10, and that term is standards. So we put together the budgeted amounts last week, but in fact, those budgeted amounts came about because the company had established a standard that they wanted to adhere to for the manufacturing process. So for direct materials, as an example, we have two standards. One standard is how much material we think we should be using per unit, and that standard is 4 yards per unit for this particular example. The other standard is how much should we be paying for that material, and that standard we identified as $5 per yard. So you'll remember, if we take our $4 standard, 4 yard standard per unit of material and multiply it by our $5 standard per yard, that's how we came up with our $20 cost, budgeted cost per unit. We did a similar exercise for our direct labor and came up with a standard of an hour and a half. What we're saying there is we would anticipate that it would take our direct laborers 1.5 hours to complete 1 unit of product. Our standard for payment was $10 per hour, and that's how we came up with our budgeted cost per unit, or standard cost per unit, of $15. And then we did the very same thing for our variable manufacturing overhead, which, remember, we determined we would be allocating variable manufacturing overhead based on direct labor hours. So our standard for the allocation base is actually the same as our standard for direct labor, 1.5 hours per unit. Our cost, which is effectively our the variable portion of our predetermined overhead rate, is $6 per hour, and that gave us the anticipated cost of variable manufacturing overhead cost per unit of $9. So again, this standard is something that management comes up with, and there are a number of different ways to look at how you arrive at your standard. We won't in this course go into a lot of detail on that, but management needs to kind of make a decision. Do we go with something called ideal standards, which is in a perfect world, how much material would it take per unit, or how many hours should it take us, which can motivate perhaps because it can set something for the employees to aspire to, but it can also be demotivating because typically ideal standards are not achievable just by the nature. A different approach might be practical standards, which basically takes into the consideration that there may be downtime due to delays in getting material, due to malfunction of equipment, things like that. And so oftentimes a practical approach to a standard is more productive because it's actually attainable. You can read more about those types of decisions if you're interested. We're going to focus now, though, on what do we do with this data, these standards. So the assumption page, as I said, everything is exactly what it was in the example we used last week. If you need to review that data, feel free to take a few minutes to do so. I want to move to the second worksheet here, which also came from our work that we did last week. This is the schedule of the revenue and spending variances. Notice that when we get to this level of analyzing our variances, we've already eliminated the impact of the activity variance. So what we're doing here is just taking a look at how do we take our spending variances and extract more information from them. So we're going to be focusing strictly on variable costs. You can also do some analysis with fixed cost variances. It's a little trickier. In your textbook, they actually go into it in the appendix of chapter 10, and feel free to read about it. And if you have questions, raise them with me. In the interest of time, we're going to, in this class, from a formal perspective, only focus on the variable variances. So we're going to be looking at this $7,300 favorable direct material spending variance, the $31,200 favorable direct labor variance, and then the $16,000 unfavorable manufacturing overhead variance. And what we're in essence going to be doing with these, again, is taking a look at how much of the contributing factor to this variance is because we used something other than 4 yards per unit, and how much is it due to the fact that we paid a different cost per yard than $5. Okay. So if we look at this worksheet entitled Price and Quantity Variance, this is where we're going to do our further analysis. And I want, first of all, we're going to look at direct materials variances, but I want to identify some of the abbreviations I've used and make sure those are understood. AQ, very simply, is the actual quantity of yards of material that we used. In this example, that's our 77,000 yards of material. AP is the actual price per yard that we paid, which in this example is the $5.10. SQ, this is a little trickier. I want to spend a minute on this. Standard quantity of yards for actual level of output. Standard quantity of yards for actual level of output. So our standard quantity, you'll remember, of material was 4 yards per unit. Our actual level of output, though, was the 20,000 units that we actually sold. So our standard quantity of yards for actual level of output is the 4 yard standard times the 20,000 units that we actually sold. This is a concept that people get confused sometimes. It's really not that difficult if you think about the fact that what we're doing here is we're identifying the standard quantity of input applied to our actual level of output. That's effectively what makes our flexible budget. We'll see it in action in a minute. And then the standard price, the SP is the standard price per yard, which in this example for direct materials is the $5 per yard. Okay, so let's look at our little analysis here. You'll notice I'm going to walk us through this two different approaches. This first approach is more of a visual, and I still remember these many years later that when I learned about variances, this presentation I found very useful. So I always start with this. So in the far left corner, you'll see AQ times AP, which is our actual quantity times actual price. So it's strictly the 77,000 times the $5.10. Then over to the right, you see SQ times SP, standard quantity times standard price. This is effectively our actual budget. And so if you look at the formula, it is taking the 20,000 units we sold, multiplying it times the 4 yards standard per unit, and times the $5 standard cost. And that gives us 400,000. If you go back over here, you will see that that's actually our flexible budget, and that the first number we calculated is our actual results. Right here, I have taken the difference between those and identified that as the 7,300 spending variance that is favorable, and you can see that that's the same number that we created in our schedule from last week. Okay, so all we've really done now is confirm what we had done last week. We still need to break it out. And that's where this center column becomes critical. AQ times SP. So in this column, what we're going to do is we're going to take the actual quantity. This is the actual quantity of materials, the 77,000 yards, and we're going to multiply it by the standard price, which is the $5. And that gives us $385,000. Now, truthfully, that number doesn't appear anywhere in any financial or anything else. It's strictly a number that helps us break out what we need from an informational perspective. So if we look at the column AQ times AP and the column AQ times SP and take the difference between those, that gives us $7,700. That is what is referred to as the price variance. And think about it. The 392,700 used actual quantity and actual price. The 385 used actual quantity and standard price. So the only difference between those two numbers is the price. So this $7,700 is the amount of the variance related to the fact that our actual price per yard of material was different than our standard price per yard of material. And in this case, notice it is unfavorable because the actual number is bigger than the standard. And if you look back at our data, it's intuitive because we paid $5.10 per yard when our standard was $5 per yard. So we would have expected that to be unfavorable. Now, let's go over to the right and take the difference between the middle column and the far right column. And what we get is $15,000. This is our quantity variance. Notice the only difference between these two columns is in the middle column we used actual quantity In the far right column, we use standard quantity for our actual level of output. The price in both instances was standard. So this $15,000 arose very simply and strictly because we ended up using a different amount of material than our standard had implied that we should. And in this case, that variance is favorable because our number that uses the actual quantity is less than the number that uses the standard quantity. Now, if we take the $15,000 favorable variance and net it against the $7,700 unfavorable price variance, notice that what we get is our spending variance. So what we have effectively done is just shown that the price variance, or the $7,300 spending variance, is partially due to the fact that we have an unfavorable price variance, but that is more than offset by the fact that we used less material. Now, we can think of a number of reasons why this might happen, but here's the critical piece. To find out why this happened, we need to go to two different directions. The price we pay for our for our direct materials is probably determined by the purchasing manager, who makes the decision as to where and at what price we purchase the materials. The amount that actually goes into production is most likely determined by the production manager. That's why it's so critical that we are able to break them out so that we can go to the appropriate department or individual to ask the whys. Now, if we were sitting together in class, I would generate a discussion and say, okay, let's think about why the price variance was unfavorable. And we could come up with a lot of things like prices increased due to shortages of raw materials. We changed vendors. We couldn't get the same deal. We bought a different quantity and were unable to get a bulk discount that we had planned on being able to get. Or one I always like to kind of run with is maybe we bought a higher quality material. Maybe the purchasing manager had a discussion with the production manager who said, you know, our material lately hasn't been a very good quality. Could you see if you could get a higher quality material? And the purchasing agent is able to do that, but the fact is they end up paying more for that higher quality. So let's just say that's what we found out. So then we go to the production manager and we say, hey, we hear that you asked the purchasing agent to buy a higher quality of material. That's had a negative impact on our budget. Why did you do that? And the production manager says, well, we were having a lot of spoilage. We were losing a lot of material because of the poor quality. It ripped, it tore, we were unable to use it, and the quality of our end product was less than it should have been. And if the production manager is paying attention, they will say, look at the favorable quantity variance. The reason we had the favorable quantity variance is because we had a higher quality of material and we did not have to throw away as much material. So, point being, we break these out so that we can better understand what's going on, but oftentimes they still impact each other. So in this case, our favorable quantity variance in the scenario I just talked through is a direct result of our unfavorable price variance. But it more than accounts for it, and we may see further reaching ramifications in that if we have a higher quality product, sales may go up, and profitability may go up. Now, here's the other question to ask. If this is true, and if I, as the vice president or a person in charge, says, okay, you've convinced me, let's stick with the higher quality material, then next year we need to adjust our standards. We don't keep our standards the same. When we do this variance analysis, it's not just to look at, are we controlling our costs appropriately? It's also to look at, are our standards appropriate? So in this example, when we get to setting our standards for the next year, we need to increase our standard price and probably decrease our standard quantity of material. Because if we don't have as much spoilage or waste, we should be able to complete, and it looks like we can, a product with less than 4 yards of material. Okay, lengthy discussion on that, but know that we walk through this so that we have a better understanding. So don't forget to ask the questions about why. Now, let me walk through the alternative calculation here. Again, I do that visual because I think it's a better visual, but you can also do this in an equation format. The price variance is actually the actual quantity times the difference between the actual price and standard price. So you can come up with the same number by just taking our 77,000 times the difference between the $5 and the $5.10. Same thing with the quantity variance. You can take the standard price, which was $5, and multiply it by the difference between the actual quantity of 77,000 yards and the standard quantity, which was, remember, 4 yards times the actual 20,000 units sold, which would be 80,000, and still come up with it. So you don't have to go through this visual. You can do these equations. Whatever works best for you is fine with me. I walk through both of them so that you can go with whichever one you find most useful. Okay, let's walk through. The process is pretty much similar for these others, so I may walk through these other examples a little more quickly. The legend for direct labor variance is very similar, but because it's labor versus material, the nomenclature is a little different. AH is the actual quantity of direct labor hours used. AR is the actual rate or price that was paid per direct labor hour, the hourly rate. SH, again, the standard quantity of hours for the actual level of output. So you'll remember the standard quantity in this example was 1.5 hours per unit. To get at SH, you would multiply that 1.5 times the 20,000 actual units sold. And then the standard rate is the standard rate per direct labor hour, in this case, our $10. So we're going to go through a similar scenario. Actual hours times the actual rate is just the 28,000 times the 960. That was, if you go back to this worksheet, our actual results. Then we'll walk over to the far right and we'll take the standard hours times the standard rate. That's effectively our flexible budget of 300,000. And you can see that in the worksheet from last week. Down here, I've calculated the difference between those, which is the 31,200 favorable spending variance. Again, we calculated that last week. So again, we'll do a center column, which takes in the actual hours times the standard rate. Again, we don't see this anywhere. It's strictly used to break out our variances. And so that's the actual hours of 28,000 times the standard rate of $10 per hour. And then to the left, we'll calculate what's called the rate variance. This is the variance that arises strictly because we paid a different hourly rate than our standard. And so that's the difference between the far left column and the middle column. That's 11,200. and that is a favorable rate variance. Again, intuitively, we could have figured that out because we paid $9.60. Our standard was 10. Then we'll come over to the right and take a difference between the center column and our flexible budget number. This is what's called for the direct labor an efficiency variance. It's quantity, but think about labor. The quantity is time spent. So this variance is a measure of how efficient our direct laborers were. And in this example, again, the number that has the actual in it is less than the number that has the standard, so it is a favorable variance. And if we come over here and we add those two, they're both favorable, so we add them together, and notice we get our flexible spending variance. So we have effectively shown that this $31,200 spending variance is $11,200 due to savings by the rate we paid, $20,000 savings due to being more efficient. Now, you still want to go through and ask the questions. What would have caused a rate variance to be favorable? Well, we may have hired new employees at a lower rate. We may have hired less qualified employees. A raise that we had originally anticipated may not have gone through. And then efficiency variance, well, new employees, we would probably expect to see an unfavorable efficiency variance just because of a learning curve. Same thing with lesser skilled employees. But think back to our materials. If we're able to have less waste with our materials, then we may have been able to be more efficient because we didn't get halfway through a garment, have to throw it away and then start over. So again, keep in mind the variances need to be broken out, but they also impact each other. And then again, we can do the alternative calculation with the equations. All right, this video is getting kind of long, so I'm going to try to rush through the variable overhead variances. The legend is pretty much the same thing. Remember that variable overhead we calculated or we allocated based on direct labor. So our hours or quantity are going to be hours. If it were machine hours or something else, then this would obviously change. Actual hours times the actual rate is going to be the 28,000 hours times the $7 rate. And then standard, again, the flexible budget amount. And so you'll see those in our schedule from last week. Then we'll do and then I did come down again and come up with our flexible spending variance that we see from last week, and that is unfavorable. Now, I again came up with the center column, which is the actual hours of 28,000 times the standard rate of $6. The difference between the far left column and the middle column is the variable overhead rate variance. In this case, that's $28,000, and it is unfavorable. And that makes sense, again, intuitively, because we had an actual rate of $7 compared to a standard of $6. Now, this is the most important component of the variable overhead variance analysis, because this is where we see the impact of spending more or less than what we had intended. The efficiency variance, which is the difference between the middle column and the right column, in this case it's $12,000 favorable, is really just a measure of how efficient we were with the allocation base. Because the only difference here are the number of hours of allocation base that we used, in this case, direct labor. So it really doesn't give us information that helps us control variable overhead. It gives us information on controlling the allocation base, which in this case we already have because the allocation base was direct labor and we calculated that up here. So when you analyze your variable overhead variance, the variance that is the most critical is the rate variance. That's the one that gives you information on your variable costs. The efficiency variance just gives you information on how you're allocating the overhead. And then again, the alternative calculation we can still do. Long video. I probably should have broken it down into two. Feel free to watch it in pieces if that will be helpful.